All right, Chapter 1, Managerial Accounting, Chapter 1. Let's see. We're going to do this quickly because Chapter 1 is not a very difficult one, and we have several learning objectives to work on. So let's take a look. So first objective is to identify managers' three primary responsibilities. You should know this after this chapter, and it'll be in your homework, it'll be in your exam. All right, so there are three main responsibilities. It's the middle here: planning, directing, and controlling. So as a manager, they're going to do three main things, and all these things are used to help with decision making. So managers make decisions, and what kind of decisions are they making? And here they are, three of them. So let's take a look at each one. Planning. So planning is to set goals and objectives and how to achieve them. Okay, so as a manager, you have employees working under your supervision, and you need to tell. For example, you're making some kind of products, and let's say what product should be made, and how many, and what are qualities, and how you're going to make sure you can the cost of the products are within certain limits, so-called a budget. We're going to talk about later. So here's another example. Here is to generate more sales through the opening new stores, or reduce labor costs by reducing store hours. So it depends on the level of the manager. You may have different roles, and some of them are in charge of sales, some of them are in charge of internal the labors, and so on. So next one, the planning is budgeting. The budgets are how much do we have and do we need to complete a project or a task. So for example, we're building a bridge, and this bridge will cost, say, in plan is a budget is going to cost about $100,000. So when this budget has been made, you're basically going to finish everything within this $100,000. You don't want to go over this. This is called a budget. Directing, so to oversee company's day-to-day operations. For example, use daily, weekly sales reports to adjust marketing strategy. So if the daily or weekly sales are too low, and you want to push out more sales by providing more discounts or more advertisement, for example. Using product cost reports to adjust the raw material usage. For example, some products cost too much, and then you say, we're going to use less to make more. How do we do that? You need to do some planning, do some designing, and do some adjustments. This is directing, and to show the where the company or the operation is going. Controlling, to evaluate the results of operations against the plans and making adjustments as needed. Here we may talk about the budget again. For example, here, compare budgeted product costs against the actual product cost to take corrective actions. If the budget cost for each item is $1 and you're making that $1.50, that basically is going to affect your profit later, because you're going to have something cost too much to make, and our company needs to take a look at how can we lower this cost. Compare budgeted sales with the actual sales to take corrective actions. So your budget sales is $1 million, and actual sales is so $500,000, and it's only half of that. So you need to take a look at what's going on here. Is that to the location problem, or is it your price too high, or other competitions, or anything else? So I want to take a look at that. Maybe your combination or portfolio of your products are having problems, so you need to make adjustment on that. For example, before the Christmas, say companies usually start to have Christmas stuff in November, even October. And you're not going to expect too much sales at the time. And if you make this budgeted sales to very high, and then you say, oh, how can we make that happen? And then you're going to push out some strategy to make people to buy Christmas stuff early. All right. So those are some examples in controlling. So second objective is to distinguish financial accounting from managerial accounting. So you have taken 2110. It's a financial accounting. In financial accounting, you talk about financial statements, talk about credits or debits, and talk about accounting cycles and so on. And managerial accounting is doing very different things. So in the middle here, there are different issues. We're going to see what managerial accounting is responding to these issues and what financial accounting is responding to this. First one, who are the primary users of the information? Starting from the financial accounting side here. Financial accounting side, I think the very first class, when you took the financial accounting class, you were told that financial accounting is going to prepare some information that's used to, can be used by external users, including banks or creditors, stockholders, or government agencies. For example, the IRS is going to have take a look at your income before tax, and so that they can charge you. They want you to pay tax on it. Or the payroll, and when you prepare payroll, and the payroll is going to send a report to the government, the IRS, so the IRS knows who has been paid how much. And but managerial accounting is only for internal use. It's mostly confidential. Second issue here is, what is the purpose of the information? And those information for the managerial accounting to help external users to make decisions, okay, investing or lending decisions. And for the other one, the managerial accounting is for internal use. So managers use that for planning, for directing, and controlling business operations, and make business decisions. It's more internal. And next one, what is the primary accounting product? Financial statements, of course, for the financial accounting. But financial statements does not appear in the managerial accounting. It's basically are mainly the reports that we used by the managers to make these daily or whatever decisions to make to manage the company's business. Next one is, what must be included in the report and how must it be formatted. And for the financial accounting, we have very strict generally accepted accounting principles, GAAP, as determine the content and the format of financial statements. So it's very rigid and very rigorous. And for the managerial accounting, the reports are different companies have different format, so you cannot ask one company to do this, to follow a specific format, because it's all internalized. It's all by the company itself. So there's no, sorry, where is it? It's too much here. I moved the mouse. So next one, what is the underlying basis of the information? For the financial accounting, the information is based on historic transactions with the external parties. So you're making sales, making transactions, and those be recorded in the journals and the ledgers, and it'll be used to generate all the financial statements. And for the managerial accounting, well, some information is based on past transactions. Managerial accounting focuses on the future. So what do we do tomorrow? What do we do in the next week? What do we do in the next year? So they're basically providing information on both external and internal transactions. Okay, let's take a look more. What information characteristic is emphasized? Financial accounting says the data must be reliable and objective. So this is it's used by external users. and external users are heavily relying on the reliability of the information, accuracy of information, objectiveness of information, so that they can make their decisions well. For the internal users, data must be relevant. So it's more managers want to see the relevant information. Of course, it must also be accurate and reliable. What business unit is the report about? Financial accounting, the company as a whole, consolidated financial statements, limited segment data is provided in the footnote. So if there's anything you want to cannot be included in the financial statements itself, and you need to put in a footnote. And in the manager accounting, the segments of the business, such as products, customers, different regions, departments, or divisions, they may have different units, and different data, different information can be provided for specific units. How often are the reports prepared? We know for the financial accounting, so every year, every quarter must be prepared for the as the financial statements. But in the manager accounting, it really depends. Maybe daily, maybe weekly, maybe monthly, maybe every year, and so on. Maybe twice a day, twice a month, twice a week, and so on. It all depends on the company's business. And the next one, does anyone verify the information? Of course, auditors are always going to verify all the information in financial accounting. But in manager accounting, there's no independent auditors, but internal auditors may do the job. But it depends on the companies. It varies. Last two issues here. Is the information required by an outside group and a government agency? And for the financial accounting, yes. SEC requires publicly traded companies to issue annual audited financial statements, and no for the manager accounting, so it's internal. So external bodies will not be requesting such information from the company. Last one, is there any concern over how the reports will affect employee behavior? For the financial accounting, the concern is about the adequate of disclosure. Behavioral implications are secondary. So, but for the managerial accounting, management carefully consider behavioral implication when designing a managerial accounting system, because it's the people who they're managing, and these people are making products or making sales for the company. All right, the next objective is to describe our operational structure and the roles and skills required of management accountants within the organization. We're going to go through this objective fast because this is only very informative, but it's very easy to read. So this is structure of a company. For a public company, you should have a bigger one. Smaller ones may not have all these in the company. Okay, board of directors, chairman of the company will be here, and it's going to assign all the officers down in here. And the red part is the audit committee. It's a new thing after Sarbanes-Oxley 2002. We're going to talk about that later. So companies need to have a committee that's going to audit all the financial transactions in the company to make sure the information they record and they report are accurate and reliable. Okay, the roles of the management. So it's changing. Technology is changing, and technologies are making everything so easy. But companies need to, accountants need to have the skills to manage all this information with the current technology. The management accountants should ensure accurate financial records. It's for sure. They need to make sure that everything recorded are accurate. Planning, analyzing, and interpreting accounting data. So they need to be skillful to understand all the accounting information that's being recorded and provided in the company. To provide decision support, management accountants should know the business, and they need to know what kind of support they need to provide. For example, a company is doing some product design, and accountants may get into the design so that they know how much the newly designed product will cost, for example. And companies are not going to make the product into the market because if it's too much in the cost. So accountants are going to provide such information for decision support. Required skills of manager accountants. Okay, those are the analytical, Microsoft Excel, and other technology. And importantly, very important, we see here is ability to work in a team. So nowadays in a business, people are working in a team. So you don't want to be someone people hate you and do want to work with you. You want to be a person who can work with anyone. You need to have the written and verbal skills to communicate with others. You need to know the business. You need to have the accounting knowledge. Accounting knowledge including if you're going to go through the accounting route or management route, you're going to have the accounting classes taken. Next objective is describe the role of Institute of Management Accountants (IMA) and uses ethical standards to make reasonable ethical judgments. IMA is an organization, and it's called Institute of Management Accountants. It's a professional association for management accountants. And they have different functions listed here, so I'm not going to read those. And there are some standards, ICCC, so integrity. You can uphold the integrity. Integrity is so important as a accountant. So it's more about ethical issues here. You want to be an ethical person. Competent, so you need to be able to do the work. Confidentiality, I need to keep the confidentiality of the company, and it's quite straightforward. And perform duties with credibility. Need to be trustworthy. So it's both of these in the bottom here are basically ethical issues we're going to talk about here. Ethical behavior. So it means are you going to do the right things regardless of consequences? If the consequences may get you to lose a job, but it's the right thing, do you do that? Yeah, you have to. Example of unethical behavior is allowing to reimburse of their false expense reports. Okay, so you're not going to do that because your manager comes in. So okay, do this reimbursement for me, and it's $100,000. No, it's too much. $100, and so it's a dinner with his family. So do you do that? You can't because it's not a company business. You cannot reimburse that one. Manipulating income. Okay, so companies have later you take other classes. You know, companies have the pressure to make sure the company reports profit on the bottom line. So if the company is not doing so well, and they may have the urge to manipulate that income. So who's doing that? Accountants. So as accounting professional, and you're not going to do that. Performing tasks not qualified to perform. So for example, someone wants you to do that. Your company wants to do the tax, but you have not been certified to do that, so you're not going to do that because it's going to cause some problems to the company if you make some mistakes. So if there's any ethical dilemma, and there's some way to do that. I follow company's policy for reporting on ethical behavior. If not resolved, discuss with the immediate supervisor, or then discuss with the objective advisor, and if nothing works, then you can talk to an attorney just to look for the help. Unethical issues and unethical behavior and illegal behavior. And unethical behavior, not unethical behavior. All unethical behavior is illegal, but all illegal behavior is unethical. So some unethical behavior includes dishonesty, unfairness, lack of objectivity, and irresponsibilities. Okay. Next objective, we discuss and analyze implications of regulatory and business trends. We're going to talk about several regulations. Sarbanes-Oxley Act 2002. It's SOX 2002, and we have IFRS, International Financial Reporting Standards. We talk about a new technology, XBRL, Extensible Business Reporting Language. Sustainability is a very hard word nowadays in the business, to make sure that the company is considering the environment and a shifting economy, and it's going to have some issues on the business too. So Sarbanes-Oxley, a little bit on this, but not too much, because you're going to have this in many other classes. To restore trust in public traded corporations management, financial statements, and auditors. This happens before 2002. There were many financial scandals. Several of those are very, very famous, if you have heard. Enron, WorldCom, Xerox, many others actually. Another class I have students do many financial scandal cases. And then in the Sarbanes-Oxley 2002, there are CEO CFO requirements. They need to sign off the financial statements. So it means when you put your signatures down, you're responsible for all the errors in the financial statements. Internal control structure has to be set up by the CEO CFO, and annual assessments must be done by the CEO or CFO. And an independent audit committee. Remember in the past, in the previous slide, there's a red box. It's an audit committee, and this is an independent audit committee. It's by someone from not working in the company. Increased white-collar crime penalty. So penalties will be more on the white-collar crimes. White-collar crimes are basically called fraud, and fraud are people are doing something bad, stealing money from the company, or falsifying the company's reports, something like that. IFRS, International Financial Reporting Standards. It's something happens outside the United States, in the world. They're trying to make the standards. We are using GAAP, right? GAAP, Generally Accepted Accounting Principles. But the countries in the other part of the world is not using this. They're using their own accounting standards. And then European, Asian countries, they found they want to have some uniform standards. So they basically created something called IFRS, and there are many countries that are using that. But in the United States, where you're still using GAAP. But the SEC, Security Exchange Committee, and is now studying IFRS to see if possible we are going to use IFRS in this country. XBRL, it's a technology. It's basically a language. It's an extensible business reporting language. It's a real computer language. It's a very simple one. And the XBRL actually was created by an accountant in Tacoma, Washington. And he is a tax, I believe he's a tax accountant. And he is very enthusiastic about the technology, and he created XBRL, and then it's been a standard, a mandatory reporting language has to be used by any public companies who reports to the SEC. It's a standardized tagging system for financial reports, and there are several advantages. Decreased retrieval time. You may not have a very solid understanding. Maybe you have, but just suppose you have not been exposed to this very much. And retrieval time, it's when you have a large amount of things, you want to take something specific. It can be very difficult. For example, if I have 10 golf balls, all white, and one of that is a little bit lighter or heavier, and the other ones are the same weight. And you want to take that out. How can you do that? You need to wait one by one to find it. The worst case is the last one. It's always the worst case, actually. The Murphy's Law is always worst case, right? So you're going to get that in throughout this 10 times until you get it, up to 10 times. But what about you have a 10,000 golf balls? One of that is slightly heavier. You need to take it out, and then retrieving that ball will be very, very difficult. Okay, and so with XBRL, and it's a labeling, it's tagging. It tags every single ball with the weight on it. So now you don't need to worry about how to weight that on your own scale. It's over there. What you need to do is simply pick that up because it's marked. So it's even like this. It's all the ones with the same weight will be white. The one that is not same weight will be red. How easy is that? So XBRL makes it happen. So it's 10,000. What about 10 million? And one of the 10 million will be very difficult. But if it's red, other ones are all white. It's pretty easy now. Decrease conversion time. And conversion time is, okay, in the past, everything reported is on PDF file. So you want to take some information out, put into the Excel sheet, and you need to go through each file and pull the data out, numbers out, put into the Excel sheet. The conversion time can be extremely long. And with the tagging system, you don't need to do that because computer can take out the data directly from the reports and put that into the Excel sheet. It takes only a few seconds, if not minutes, to put everything together. But if you don't have this, it takes weeks and months to put things together. See the difference? Facility comparison. So because we have individual tagging on each data, you can compare the company's data very, very easily because they are all standardized in the way of tagging. For example, net income. So if you want to compare 100 companies' net income, okay, you only need to pull out the 100 companies from the website and then do some clicks, and you can have all the net income of the company because they are all tagged with net income. Same standard way of to name that line. It's not net profit, and it's all kind of net income. Customized information, and there's XBRL makes it possible. You can customize information. You may know this when you start working on this, so it's hard to explain this now because we don't have that on hand. More consistent with user financial terminology because it's standardized. It's very consistent using. Sustainability and venture accounting. Sustainability is very important. It's environment. You need to consider environment. You also need to consider social responsibilities. And so, for example, you don't want to make a pollution to the air. You don't want to emit the CO2, carbon dioxide, too much into the air. So this is social responsibility and triple bottom lines, but not one. In the old time, there's only one bottom line: it's profit. Now we put in two more things: people and the planet. All right, people is social responsibility, and the planet is also part of social responsibility, and more about that is the environment. Shifting the economy, we're shifting away from manufacturing towards services, and managerial accounting has expanded. And it's not only the form from the manufacturing, because in the past, managerial accounting is mainly in the manufacturing. Now we have a cost accounting, and other managerial accounting has been expanded into the service area. Competing in global market, the barriers to international trade have fallen. So we find we're making this earth a big family now. More accurate time information is needed, and manager accounting is going to make it happen. Some advanced information systems include ERP, enterprise resource planning, lean manufacturing or lean production, just-in-time, total quality management. We're going to talk about this one by one. Enterprise resource planning. In the accounting 4160 that I'm teaching, we're talk about ERP, and we have used one product, SAP, in our class. And if you're taking if you're an accounting major, you're going to take my class, and you're going to learn more on ERP. It's a system that integrates companies' functions, departments, and the data. Okay, everything put in the same place, and there's a big advantage: streamline operations because data is available when you need it. Respond quickly to changes, and because it's centralized and it's so easy to respond to the changes. Replaces separate software systems, and you don't have to have different software for different departments or for different groups, and everyone can use the same software systems, and so there'll be no issues for sharing the products or sharing information. There's a major disadvantage: it's expensive. It's sometimes prohibitive for a company that doesn't have such scale. Okay, but this issue is been changing, it's been resolving, and it's companies are designing some partial ERP and some less expensive ERP to be used for a smaller business. Lean manufacturing or lean operations. If you're doing operations management, or if you're doing the you're going to do maybe some of you are doing the cost accounting, you're going to see a lean manufacturing or lean operations. And the philosophy and a business strategy of manufacturing is do not have waste. It will lower the cost. It's going to increase competitive positions because your cost is lower and your price will be lower for the sales, and then you're going to take more market shares. And one example of lean manufacturing will be the waste, and it comes from Toyota. And the idea came from someone in the Toyota. Actually, his name's Toyota. He's the founder of the company and the founder of this philosophy. And he found, okay, if when you screw into place, and the only last turn of the screws makes the tighten, and the other turns are wasting. So he found, okay, we don't need to do that. We just need to make the last two or last one turn to make this fasten. And you may notice in your drinking, and when you buy a bottle of drink, and it's so easy to twist open the bottle because you only need to turn one rotation. You can open this lid of the cover, and this didn't happen before. In the past, you need to turn several turns so that it can open up the lid, and it's a lot easier, and it's eliminating a lot of wastes. So this is lean manufacturing, and just in time. Just give you an example. There was one commercial in the past, and one woman walking towards. He wants to buy some juice, orange juice, and he walks towards the shelf. There's nothing on the shelf, but when she reaches her hand, and there was a guy behind the shelf running from somewhere, and then towards the shelf. And when the hand of the woman reaches the shelf, the bottle of the juice reaches shelf too. So the woman simply holds on the bottle and then put in the basket, open in the cart. So this is just in time. The bottle arrives just in time, and this is going to reduce the raw material inventory, reduce the finished good inventory, reduce the storage costs, reduce handling costs. So this are all associated costs towards the storage of these products, and we may talk about this later in other chapters, in the future chapters. TQM, Total Quality Management, is I think it's also from Japan. The goal is to provide customers with superior products and our services. If you have heard something called Six Sigma, and it's going to make sure that they are setting the goals for the quality higher and higher. So there's the organization, International Organization for Standardizations, ISO, has ISO 9000 standards. That's a very high standard. So if your product meets this standard, this product can be sold to anywhere in the world. So this is the end of the chapter. Thank you very much, and I'm going to get to the chapter 2 tomorrow.